Okay, I have to continue. We have functional budget. Under the functional budget, you have the sales budget, the production budget, and raw material purchase budget. We look at financial budget. Under the financial budget, you have the cash budget, the profits or loss budget, and you have the balance sheet budget. We also explain fixed budget, flexible budget, and flex budget. After the explanation, we look at question number 2. That question number 2 is ABC. I'm trying to go to that question. Oh, okay. We look at just question 1. We only solve one question. Okay. My apology. Okay, we solve. Okay, we solve illustration 1. Eco Limited. This question is on functional budgets. We are required to calculate production budget, purchase budget, and we calculated the economic order quantity. Tonight, I want us to look at cash budget, and if time permits us, we are going to look at flexible budget. The last class we saw, we explained how to prepare functional budgets. Tonight, I want us to look at financial budgets. Under the financial budgets, we want to look at cash budgets. What is cash budget? Cash budget, this is the budget that is prepared on cash basis. Your cash budget, you are going to compare the cash inflows against your cash outflows. For your cash budget, you are going to compare the cash inflows against the cash outflows. At the end of the period, you are going to have either cash surplus or cash deficit. At the end of the period, you are going to have either a cash surplus or a cash deficit. Where there's a cash surplus, it is the duty if you prepare a cash budget and you have a cash surplus. Remember, cash budget is cash forecasting. Budget is about forecasting what will happen at a future period. If you have cash surplus, it is the duty of the company's management to decide how to invest the cash surplus. Alternatively, if you have a cash deficit, it is the duty of the company's management to decide on how to, please hold on. This is where I'm going to. where you have a cash surplus or deficit, it is the duty of the company's management to look at how to finance the cash deficit. Last week, we actually solved 2 questions. We solved question number 1, Eco Limited. We also started question 2. Look at question 2. ABC Manufacturing Company. This question we have solved. Look at the question, please. For those in class, we have solved requirements A. We have solved requirement B. We are left with requirements C and D. That means this is very good for us. Requirement C is cash budget. Requirement D is budgeted profits and loss accounts. That means we can use this question to explain how to prepare financial budgets. If you look at this question, requirements A and B is functional budgets, production budgets, and raw material purchase budgets. Requirements C and D is on financial budgets. So please, guys, go to your material. I think page 152 or page 150. Look at under budget. Illustration 2, ABC Manufacturing Company. Please, my glasses. Please, can we check your study pack? What page, please? Oh, I only have 5 students online. Please check your study pack. What is the page? The class is silent.
128.
Oh, page 128. Okay. I don't have the study pack with me. I'm using my own material. So the page is page 128. Illustration 2. Is that correct, please?
Yes, sir.
All right, please check page 128. Let us continue with this question. Page 128, question 2. Of course, we are going to read the question again. I will read again. ABC is a manufacturing company which makes a product data. The budgeted monthly production and sales are 200,000 units. A standard cost has been estimated on the basis of the cost of 7 naira of material. Standard direct cost for material is 7 naira. Look at 2 kg as 3 naira 50 kobo per kg. Wages 6 naira. This is equal to half an hour at 12 naira per hour. In addition, variable overhead has been determined at 2 units, and monthly fixed overhead costs are 200,000 naira. Monthly sales for the first 5 months of next year. Look at the estimated sales for January, 210,000, February, March, April, May. The next paragraph. Actual sales at the end of 2014 were 190,000 in November and 220,000 in December. Next, cash received from the sales is based on previous experience. Now, please pay attention to this. Cash received from sales is based on previous experience and is expected to be received 60% in the month of sales, 25% in the following months, 10% 2 months after the sales. It is expected that 5% will be irrecoverable and will be written off in the month of sales as bad debt. The selling price is 18 naira per unit. This paragraph is needed for cash budgets. This paragraph is needed for cash budgets. Next paragraph. Creditors for raw material are paid at the end of the month in which they are incurred. That means raw materials are paid for the same month raw material cost is incurred. Wages are paid the same month as incurred. Variable production overhead are paid 50%. Please, just 1 minute. Variable overhead are paid 60% in the months, 40% in the following months. Fixed overhead include 25,000 naira of depreciation and are paid 1 month after the costs are incurred. At 1st January 2015, creditors for variable and fixed overhead are estimated at 92,000 and 150,000 respectively. Next, the company intends to have finished goods at the end of each month, equivalent to 15% of the following month budgeted sales. For raw material stock, the policy is to have 25% of the following month production requirements. Stock as at 1st of January, estimated at 22,000 units of finished stock and 104,000 kg of raw material. The cash naira. I mean,
I can't hear you, sir.
is speaking on the band. Requirements produced at the month of January 2015. A production budget in units. We have done that. Raw material purchase budgets. We have done that. Now requirement C, a cash budget. So we are going to produce for 3 months, January, February, and March. We are going to start the cash budget. All right. I think I can use here for my cash budget. Requirements C now. Cash budget. Use 3 months. January, 3, you have sign. Then you're going to have your cash inflows. Create a space. Then we have after the cash outflows. Create a space. Now let's go to question. For this cash bucket, we are going to talk about paragraph 3 and 4. Let's go to the paragraph. Paragraph. Cash received. Look at the pattern of receipt. 60% in the month of 20% in following months, and 10% 2 months after days. That is how cash is collected. Now let's go to working. We are going to use this page for our cash budget. Then the next page, working. Working one. Working one. Analysis of sales receipts. If you are preparing cash budget, you are interested in the cash collected and the cash spent. Cash collection will come from sales receipt. Now, the analysis, you have the months. We use it. You have months. Now we are going to November 2014, December 2014, January 2015, February 2015, and March 2015. This is 2014. This is 2015. If you look at the question, space, value. I need to get sales value for this period. I can start with sales units so that I can be clearer. Let me start with sales units. The sales units for November, let me take you to that place that you'll be wondering, where am I getting this figure from? At the end 2014, were 190,000 in November. That is the units in November and December. Then January, budgeted sales 210. February, budgeted sales 180. March 210. Let's go to our working. Before I go out of that, let me also show you selling price per unit, 18 naira. So let me go to the working now. Quantity for November, 190,000 units. For December, units. That is sales in units. Budgeted sales for January, 210. For February, 210. Now, selling price per unit. The selling price is 18 naira. 18 naira. 18 naira. 18 naira. 18 naira. Now you can get your sales revenue. Please get your revenue. 190,000 multiplied by 18. What do we have?
3,420,000.
This will give us, okay, assuming 30 up. 3,420,000. 30 up. What do we have here? 220 multiplied by 18.
3,960.
3,960. What do we have here? Multiply 30 is up.
3,780.
3,780. Multiply this. What do we have?
3,240.
3,240. Multiply this. What do we have?
3,780.
You have gotten the sales revenue for the respective months. That means in November 2014, the revenue was 3,420,000. We have for December, we have for January. Now, out of this revenue, how much do we collect as cash? That will now take us to collection pattern. Collection pattern. Examiner states 60% to be collected in the month of sales. In the month of sales, in the month of sales. 25% the following month. 10% 2 months after.
December date.
This is the collection pattern. Now look at November revenue. The revenue is 3,420,000. That means in Naira fine is here, 30 up. Don't forget 30 is up. In November, we are going to collect 60% of 3,240,000. Please compute.
That is 2,052.
2,052. This will be collected in November, the month of sales. We are still dealing with November. We are going to collect 25%. Look at the following month. After November, the following month is what? December. December, we are going to collect 25% of November sales. Compute 25% of 3,420.
855.
855. We are going to collect that in December. You observe that I place it under December.
Oh, yes, sir.
Okay. 2 months later, we are going to collect 10%. 2 months after November, that will be
January.
2 months. That will go to January. 10% of 3,420 to be collected in January. That will give me 340. Look at it. 60% November, 25% December, 10% January. We now move to December revenue. December revenue, 3,960. 25% will be collected in December. Compute. Sorry, 60% to be collected in December.
2,376.
376.
2,376. We move to a month later, the following month.
That's January.
25% to be collected. That will take us to January. Please compute. 25% of 3,960.
990.
990. 10% to be collected 2 months later. That will take you to February. 396. Can we see that?
Yes, sir.
You are done with December collection. Go to January. In January, the revenue is 3,780. 60% to be collected in January. Compute 60% of 3,780.
2,268.
2,268. Then 25% the following month. That will take you to February. 25% of 3,780.
945.
That will be collected a month after January. That will take us to February. 10%. That will take me to March. The 10% is 378. We are done with January collection. Move to February. February revenue is 3,240. 60% to be collected in the month of sales. Please compute.
That is 1,944.
1,944. 1,944. 25% to be collected the following month.
810.
That will be collected in March. 810. 10% to be collected 2 months later. That will go to where?
April.
We are not interested in April budget. So you are going to ignore. 10% to be collected 2 months later. That will take us to April. But we are not interested in April budget. So you are going to ignore it. Then March revenue, 3,780. 60% to be collected in the month of sales. Please compute.
2,268.
The rest we go to following month. April. We are not interested in April budget. Our January, February, March. Look at the collection. We are not going to add. $2,268 plus 990 or 2. What is the collection for January? Some please.
For January, I have 3,600.
1,600. Move to February, sum up.
For March, sir,
19.
3,456. March.
3,456.
March.
Oh, 3,456.
For
now
February,
who is giving us
3,285.
285. These are the cash collected for January, February, March. You can now return to your budgets. Receipts. This is 3,600,000. 3,600,000. This is 3,285,000. This is 3,456,000. You have gotten your sales receipt in cash. Cash collected in January, 3.6 million. Cash collected in February, 3,285,000. Cash collected in March, 3,456,000. That is the collection. That is the inflows to be expected in January, February, March. We now go to the outflow. For this question, we only have one cash inflows. For this question, we only have cash. Some question you might have more than one cash. So please, we now move to the payment and cash outflow. Now look at the next paragraph. Creditors for raw materials are paid at the end of the month in which they are incurred. That means raw materials are paid the same month the raw material is purchased. We now go to it. Let's go to our raw material budget. Look at the raw material budget. We prepared this last week. Look at this. This 1 million, we prepared this last week. Raw material purchase in January. The purchase cost 1,463,875. February, look at the purchase cost. This is the value of material purchase. We now need to pay for it. Now our cash budget. I will do it small. Here you are. For material. January 1,463,875. February 1,338,750. March, we are going to pay 1,492,750. That is outflow. Next.
Labor or wage.
Wages are paid the same month as incurred. Let's go and calculate monthly wages. Let us calculate monthly wages. Look at it. Wages is 6 naira per unit. Wages is 6 naira per unit. We now need to do a working. This will come from your production budget. Look at it. In January, we are going to produce 215,000 units. February, we are going to produce 185,500. March, we are going to produce 211,500. We are going to use this to calculate labor wages. Wages is based on production. Per unit, we are going to pay you 6 naira. So if you produce 215,000 in January, what is your salary? Let's show the working.
3,440,000.
Working 2. Let's show the working. Working 2. Labor wages. We have the months. January, we are going to produce 215,000 units. February, we are going to produce 184,500 units. March, to produce 211,500 units. Labor cost per unit, 6 naira, 6 naira, 6 naira. Please multiply. What do you have here?
1 million, 1.2 million.
1 million,
290,000.
290. Next.
1,107,000.
107,000. Next.
1,269,000.
269,000. So in the month of January, you are going to be paid 1,290,000. You go back to your budget, payment for wages now. Remember cash budget, cash inflows, and cash outflows. Can we come here? Wages, 1,000,000, 1,107,000, 1,269,000. That is cash outflows. In January, we are going to pay 1,290,000. February and March, we have computed. Next. Variable overhead cost. Examiner says variable overhead are paid in the months in which they are incurred and 40% in the following months. Let's go and treat this. For variable overhead, we are going to pay you 60% in the months the variable overhead cost is incurred. 40% to be paid the following month. So let's go to this. Before that, if you look at paragraph 1, it said variable overhead has been determined ₦2 per unit. We need to calculate variable overhead cost incurred first. So working 3. Please look at this, please. Working 3. Variable overhead costs incurred. Please note, there is difference between cost incurred and cost paid. Look at the incurred. In January, we are going to produce 215,000 units. Variable overhead cost per unit is ₦2. We are going to produce 184,500 units. The variable overhead cost per unit is ₦2. In March, we are going to produce 211,500 units. The cost here is ₦2. So please multiply. What is the overhead cost incurred for the month?
430.
This will give me
430.
430 is incurred in January. How much here? 369 incurred in February. Next. $423,000 incurred in March. You have computed the variable overhead cost incurred. The next working is, what is the variable overhead cost paid? You have computed variable overhead cost incurred. Then your working for is variable overhead cost paid.
Yeah, I tell you.
No, MTN is the largest network.
Eh? Come again, sir.
I said MTN is the largest network.
I see it, Mama. Largest indeed. Don't be by size, so.
Now working for. Okay, don't be annoyed though. For me, that has been the strongest network that I use for my classes.
Ewo.
Now working for. Okay, well, don't be annoyed. Work. Analysis of variable overhead paid. Analysis of variable overhead paid. We start with the months. We have month of January. February, and March. Okay, we now have the payment pattern. The payments pattern. The question says to be paid in the month incurred, 60% paid in the month incurred, 40% in month. Now let's go to this quickly. Look at this. Month of January, we incurred 430,000.
Yes.
60% will be paid in January. 40% to be paid following month. Please compose.
258,000.
Percent of 430.
258,000.
This will be paid in the month of January. 258,000. 40% to be paid following month. What is the following month after January?
March. In February.
February. Please compute 40% of 430.
172,000.
This will be paid in February. This is January overhead. 60% paid in January, 40% paid following month. Go to February overhead cost input.
369,000.
Oh. Flying. 369.
Yes, sir.
60% to be paid in January, 40% following month. Please compute.
60% to be paid in February, 221,400.
60% of 369,000.
221,400 naira. 221,400.
And for paid in February, 8 months. 40% paid in March.
147,600.
147,600. Place under March. March overhead cost 43,000. 60% to be paid in the month of March. Balance following month.
253,800. 253,000.
How much?
253,800.
253,800. Balance to be paid when?
Ignore. That should be April.
I'll go to April. Thank you. Now look at this place. That means there should be overhead cost at 20. This paid in December, balance to be paid in January. Let's go to the question. Let's go and pick it. It's in the question.
Okay.
Now look at this place, please. As at 1st January 2015,
Yes.
creditors for variable and fixed overhead. Look, and fixed overhead. I estimated at 92,001. That means the creditor for variable is what? 92.
No.
As at 1st January, the creditors for variable overhead. That means the variable overhead was incurred in December 2014 to be paid following month after December is January. We are going to pick that figure. You come here. $92,000. Creditors for variable overhead costs. This was incurred in December 2014 to be paid following month after
This is January.
December, January 2015.
So that should be 40% of the December.
You can now do your addition now. Over in January, we are going to pay these two. Some we are going to these two.
350,000.
March, we are going to pay this 350,000 to be paid in January. Some
393,400 February.
393.
400.
Some
March 401,400.
$401,400.
400.
This is the payment for 393,400, 401,400. You can now go to your cash budget. Payments for variable overhead, HO. 350 to be paid in January. 393 to be paid, 393,400 to be paid in $100 to be paid in March. That is your payment for overhead. We now come to payment for fixed overhead. That is cash outflows. Payment for overhead.
That is constant now.
Question.
It's constant.
Look at paragraph 1. Monthly fixed overhead are 200,000 naira. Please note that. Next. Now come here. Fixed overhead. 5,000 naira of depreciation and are paid 1 month after the costs are incurred. We now need to treat this in our cash budgets. Overhead cost is 200,000, but it includes 25,000 of depreciation. Depreciation is a non-cash item.
Okay.
Depreciation not enter cash. That means we have to exclude depreciation. Next, overpaid 1 month incurred. That means the overhead cost for January will be paid in February. The overhead cost for February will be paid in March.
So minus 25 from February and March. $200,000 minus 95, that's 100.
Let's do this analysis. That will take me to working
5.
5. Okay. Working 5.
It's overhead analysis.
Monthly overhead cost. The amount is
200,000.
200,000. Now less depreciation. It includes depreciation of 25,000. This will give us 75,000. This is our cash. Monthly fixed overhead cost, the cash. Now the question now says overhead cost for January to be paid 1 month after. That will go to February. Let's go to it. Yeah. Overhead for January 175,000. Only in February, 1 month after. Overhead cost for February to paid in March. Which one are we going to pay in January? That means there must be overhead cost that was incurred in December 2014. Go to the question. What is the creditors for fixed overhead? Now look at it, please. At 1st January, creditors for variable and fixed overhead are estimated at 92,000 and 150. That means the 150 is for fixed overhead. You now come here. Go back to this will be paid in January. When is that you have to be going front and back when you are online class like this. Yeah, now for me. Creditor for fees overhead is 150. There's no for depreciation, so it does not include depreciation. List all your cash outflows. Now, Storm, get your total cash outflow for January, February. You are going to sum from here. Material to fees overhead. Total cash out. Less sum.
Cash flow for January. Cash outflow.
Yes, we are listening.
3,253,875,000.
3 million.
253,000.
Give me two what? Two.
253. 253. 253.
8.
75.
Go to February, sum up.
February 3,014,150.
3 what?
3,014,000. 3014
014
150.
150. Okay. Oh, allow me to pick it.
March 3,338.
150. 3 million.
338.
238.
3,338. 3,338.
Okay, 338.
Yes, sir. 150.
15. Please allow me to. The space is not allowing me to move. 3 million. 338 150. I need to create that space. 3,338,150. Okay. Now you compare the cash inflows against outflow. That will give you net cash flow. 3 million. 253,875. What do you have here?
346,125.
6.
346.
1, 2, 5. Next. 3,014,150.
270,850 naira.
270.
850.
850.
Yes, sir.
Next, cash inflow minus outflow.
117,850. 117,850.
117.
850.
Are you sure of this figure, sir?
So let somebody confirm, sir.
They left you to be doing everything. Some are just looking at it.
No, they might be writing, you know. They might be writing it down. Yeah, sure, BC.
It's correct.
Thank you, sir.
So here we have, I have 117,
850.
850. You now introduce opening cash. Opening cash balance. If you look at the question, examiner says, as at 1st of January 2015, the opening cash balance is 13,000 naira. Look at it, the cash balance as at 1st January is 13,000.
So this
Just
is a
bring
surplus.
it here. $13,000. Now, get closing balance for January.
359,125.
Closing cash balance. You are going to add the two. That will give you 3 what?
359,125. 125.
125. Now, what is closing the closing cash balance for January becomes opening for February? 359,125. Now get closing for February. 270,850 plus 359,125.
629,975.
629,975.
975.
Closing cash balance for February becomes opening for March. 629,975. Now please add
774,825.
774.
825.
825. You are done with your cash budget. The keeper says prepare budgeted profit and loss for 3 months ending March 2015. Prepare budgeted profit and loss for 3 months ending March. Now, please note, if you prepare cash budget is prepared on cash basis. You are going to look at the cash received and cash paid out. But if you are to prepare profit and loss account budget, this is prepared on accrual basis. What is the difference? Under accrual basis, if you prepare your income statement, sales is recognized or revenues recognized once the goods is sold. Whether we receive cash or not, we are going to recognize the revenue in our profit account. Once you make sales, whether you have collected the cash or not, the revenue will be recognized in your sales book, in your income statement. And cost is recognized once the cost is incurred. So please, let us remember the accrual concepts. When we prepare accounts, financial accounts, our income statements, our balance sheet statements is prepared on accrual basis. But cash statement is prepared on cash basis. So let's go to this. I will use the next. I'm going to use the next page. Budgeted profits or loss for 3 months period ending 31st December 2015. You are going to start with the months of Spain. I have the month of January. I have the month of February. I have the month of March. Then you are going to have the total. You start with your state revenue. If you look at the working we did, you are not going to print the cash. Look at the sales revenue working. Revenue in January, 3,780,000. Whether we collect the cash or not, that is the revenue for January. Revenue for March, 3,240,000. Revenue for January, 3 million for March. For February, 3,240,000. March, 3,780,000. Go to your profit accounts. Pick your revenue. 3,780,000. 3,240,000. 3,780,000. Please, what is the total revenue at the end of March? Sum the total. What is the total? People are sleeping in that room.
We are here with you.
Jacinta.
$10,800,000.
They have slept off. Olamide.
10,800,000.
I'm not sleeping, so I'm with you guys.
10,800,000. Okay. Now we are told the bad debt 5%. If you look at the question, examiner say 5% is bad debt. Let me take you to that space. I can understand. It is expected that 5% will be recovered and will be written.
In the month of 6 as bad debt.
How much here? 5% of 3,377,780. That should give us 189,000. 5% of 3,240,000. How much?
162.
162. 189,000. Please sum the three. That will be total bad debt at the end of March. Please sum the what do you have? That should be 540.
440. Aṣáájú. Aṣáájú.
Yes, sir.
It's 440. Oh.
440.
Yes, sir.
Please check again.
189 plus 162 plus the third one, is it 189 or 181? March.
What's the answer? Is it 440 or 540?
The third one, March, bad debt, is it 189 you wrote or
It's
181?
540, so.
It's 189 and the same thing.
Okay.
It's 540.
So what's the
540.
difference? What do you have here?
No. 3,691,000. 3,691,000.
3,691,000. 691.
Yes, sir.
This your figure is scaring me.
591. 591.
Big
3,591,000.
9.
Láti wá o.
Abi?
Yes, sir. Another 0. Don't know. Okay, 5 now. Yes, sorry.
Next, it should be 3,000,000.
78,000.
591,000. This is 3,000,000.
1, 6.
078.
Yes.
What is the total here? 10,000,000. 260. Abi?
Yes, sir. Yes, sir.
You have gotten the net sales. Now come to your cost. Cost. Now there's difference between material purchase, use function. Here I'm going to take material used cost. Go to your material purchase budget. That is option 2. Yeah, look at this. Production requirements. For production in January, we require 430 kg of material. For February, we require 369 kg of material. For March, we require 423,000 kg of material. I can use this to calculate material used for production cost. That is cost of material used for production. If you are preparing your profit, it is not the cost of material purchase that matters. What is the cost of material used for production? That means I need to do some work here again. The Lord is asked. I'm just trying to finish this question. I'm really tired. Okay, look at it. I will do the working here. Working. Cost of material used for production. January, material for production is 330,000 kg. February, material production is 369,000 kg. March, material for production is 423,000 kg. What is the price per kg of material? 3 naira 50 kobo per kg. 3 naira 50 kobo per kg. 3.50 naira per kg. This will give you cost of material used for production.
1,545,000.
If you work that out, for the first one, 1,505,000. Second one,
1,291,500. 1,291,500.
291,500 for March. 1,480,500.
Yes, sir. 500.
Cost of material used for production. Now come here. Material use cost 1,505,000. 1,291,500. 1,480,500. Total, sum of the total.
$3,000,000.
Total is 4,277,000. 277,000. That is the cost of material used for production. Next, labor cost for production. This will not change. The labor cost we have computed before.
1,290,000.
Look at
1
it.
million.
1,290,000. 1,107,000. 1,269,000. That is the labor cost for production. Just flying around. 1,090,000. Moses, are you there? 1,107,000. 1,269,000. Get total labor cost at the end.
3,666,000.
That is 3,660,000. When you are done with labor cost, go to your variable overhead cost. Variable overhead. Under profit and loss, variable overhead cost incurred in January, February, March, whether we pay for it or not. Go to your working. We have done this working.
The first one is
350.
30,000.
Thank you.
For
Is that
January.
Moses?
Yes, sir.
Moses, you are back.
369.
40,000 incurred in January. 369,000 incurred in February. 423,000 incurred in March. Total at the
Yes.
end of March. Come up.
1,222,000.
1,222,000. are not going to say the fees overhead cost is 200,000, including depreciation. Under your P&L, depreciation is $200,000, 200,000 monthly. At the end of the month, it becomes 600,000. Look at it. The only time I want to give you challenge, you don't get to production. It is the cost of raw material used, not the cost of raw material purchased. Now, some of us cost for match, then total.
For January cost, sir.
Yes, Mr. Abdulatif.
3,425,000.
3,425,000.
425,000.
For February, 2,967,500.
2,967,500.
967,500.
For March,
3,372,500.
3,372,500. Total,
9,765,000.
765.
9,765,000. 30, Abi.
Yes, sir.
You have gotten the manufacturing cost. When you are done, close this, close this, close this, but don't close at the end the month. The manufacturing cost at the end of March is 9,765,000. But that is not the cost of goods sold. That is the cost of goods manufactured. Let me explain that again. For the 3-month period, the cost of manufacture is 9,765,000. When you are done with cost of manufacture, we now need to compute cost of goods sold. To do that,
Let's decrease in stock.
this is production cost. At the Now introduce plus opening stock minus go back to at the end of January. What is the opening stock? Then at the end of March, what is the closing stock? Let's go to the question. Like it is God mercy that is keeping lecturer home. I've been speaking since 8 o'clock. Please hold on. Now look at your question. Stock at 1st January 2015 are estimated at 22,000 units. That means at the beginning of January, our opening stock in units is 22,000 units. We are still going to value it. Don't worry. Now let us look at stock at the end of March. Go to your production budget. Go to your production budget. Look at it. Look. At the beginning of January, opening stock is 20,000. At the close of January, what is the closing stock here? 33,000 units. We have gotten the opening stock and closing stock in units. We now need to value it now. We have gotten the opening stock and closing stock in units. I can do the valuation here. Opening stock. We have 22,000 units. Closing stock. Our closing stock, please hold on, closing stock, valuation. We have 33 units at the close of March. Now, we need to look for the price for valuation. Go to the question. I will show you the price now. Look at it. A standard cost has been estimated on the basis of direct cost 7 naira of material. That means direct material cost is 7 naira. Wages is 6 naira per unit. Variable overhead is 2 naira per unit. Please, when valuing your stock, you don't include fixed cost. Now come here. Look at the cost for valuation. I don't even know. Let me use it. I think this is more, this is better. My opening stock value. I have 22,000 units. Then the cost is, look at the cost. Let me put that one here. Direct material cost 7 naira. Direct wages 6 naira. Overhead 2 naira. If you sum this, 15 naira. That means cost per unit 15 naira. Come here, multiply this by 15. That will give you 330,000 of your opening stock. Your closing stock, the closing is at end of March. As at end of March, we have 33,000 units closing stock. The cost per unit is, or price per unit, 15 naira. Please value your closing stock.
495,000.
That will give you 495,000. You can now return to your computation. Opening stock value, add it, take it to the last. 30,000. Closing stock value less 49500. This will be in brackets. Let me rewrite this. So you now move to the profit or loss account is prepared ending March. So you don't do monthly. This is 33000. That means 9,765,000 plus 330 less 495. We give you your cost of goods sold. Cost
9,600,000.
sold. What do you have here?
9,600,000.
Cost of goods sold is 9,600,000. You can now get your profit. Your profit is net sales minus cost of goods sold. Look at the net sales at the end of March. The net sales is 10,260,000 minus 9,600,000. is the profit?
660.
The profit is 6. $660,000. You are done with budgeted profit or loss. You are done with your budgeted profit or loss. I know we are really tired. Some of us, we are just listening to the class. Also, some of us are actually following. But please, you need to create time to review what you have gotten. After the class, Moses, please. I will have to ask one still. Last week video on budget. You can have the two uploaded. All right, we are going to stop here. I'm even tired.
Oh, thank you, sir.
We shall stop here. Any question, please?
I wouldn't mind to give you water if it will be we together.
I even have water here.
Yeah.
I will take you one drink here.
Toshiwaju,
Yes, please.
sir, are we going to have the flexible budget in next class, or this is the last example for?
We have to do flexible budget too.
Sir?
We are going to do one more class for budget.
Okay. Okay.
Because you have not even done flexible budget. And there's nothing we can do. You know, during that Salah break, our class was cancelled. Remember?
Yeah, that's true, sir.
We couldn't have that class on Monday because I was ready for the class. I was surprised when they said they were doing a FR. But Obi, we can't undo what has happened in the past.
That could be possible in the future, in this era of technology and whatever.
So
anything.
Now that we have voted some, but can we undo it? We can't change the election now. We have voted for the president. We can't undo it.
Ashwaju?
You have to wait for 4 years. Yes, sir.
With the way things are going, this future we are looking at, anything could possible. You can't predict.
But we cannot undo the election result.
But let us close the class, sir. When we meet in the future, I will remind you.
All right. May God give us a better understanding.
Amen. Amen. Amen.
Let us try to review our notes. Some of us we have the video, we have the working notes, but we are not looking at. You are waiting for when you now start. Maybe you are going to take your leave. That will be too much. You are supposed to review your material every day. For this exam, it is reading every day.
Yeah.
The question of I'm working, I'm tired. No. You are going to create that time